Good morning and welcome to today's webinar. We'll be looking today at VAT on property transactions. Our presenter is Brown Butler's VAT Director James Hurst. We'll be focusing on some of the questions we get asked most frequently by clients and other professional advisors around property disposals, transfers and purchases. The webinar is scheduled to run for 60 minutes and the presentation will last around 45 minutes. So there'll be plenty of time for questions afterwards. If you've got a question that you'd like to ask, please use the Q&A facility at the bottom of your screen and we'll answer as many of these as possible at the end of the webinar. The webinar is being recorded and will be available on our website afterwards at www.brownbutler.com. James, over to you.
Thank you, James, and good morning, everyone. As James just explained in his introduction this morning, I'll be running through different areas of VAT and property, and the common theme being property transactions. But there's a variety of topics, and they're prompted, in my mind, as James said, about some of the things that we see with clients that have come across my desk in the last year, for example. Some recent VAT cases that give some significant pointers to what's happening in the VAT world in relation to VAT and property, and looking at some points where HMRC have actually raised some uncertainty in relation to certain types of property transaction, where HMRC have suggested that they might be changing their view, but they haven't necessarily changed their published position. And then there will be some sort of mention, I think, on some issues to do with, in particular, zero rating that maybe aims more at developers, but sometimes with VAT things stray between the transactional side and the development side. But what I'm going to kick off with is focusing on one particular area prompted by a recent case that has excited us in the VAT world. I'm got my excited face on at this particular case because it's been going through the courts for a number of years now, and it teases out a point that always caused some difficulty. Something I saw a number of times doing due diligence assignments on care home groups, where properties have been disposed of, residential care home properties have been disposed of, maybe within the group or to an outside investor and so on, maybe as a sale and lease back, and whether this triggered a VAT charge. And I think before we get into the detail of this particular case, it also just reinforces the point in my mind of getting the basics right in terms of the VAT treatment of the disposal of commercial property. And I think the other aspect here that is interest to those of us in the VAT world is that VAT is a transactional tax, and we always look very much at the different transactions as they take place in a chain of transactions. And there's often a reluctance in VAT law to look at a series of transactions in the whole, whereas in this particular case, that's certainly the line that the courts have eventually taken. And before we get into the detail, as I said, there's often, I think, the basics are overlooked in terms of disposing of property. This particular case is looking at a sale and lease back, so a very particular type of transaction. But when you are looking at commercial property and selling it, you can have a range of different VAT treatments. The sale of the existing property is normally exempt from VAT, and that's always going to be your starting point. But we know that there are exceptions to the exemption. So there's in the law, there's a very specific list of exceptions, and those include things like holiday accommodation. So that's one matter I've seen recently, where was something a dwelling or was it actually holiday accommodation? And therefore, if it's holiday accommodation, the exemption flips around to being subject to VAT on the disposal. And if you have an existing building and you're selling it and it's a commercial property and there's no option to tax, you might think, well, that's great, we just can treat it as VAT exempt. But actually, if that property was a new commercial building, which means in VAT terms, up to 3 years old, then the disposal, freehold disposal of that property is a mandatory standard rated supply. So sometimes I have over the years seen clients fall foul of that, where they've sold a new commercial building, not realizing that it's subject to VAT in the absence of an option to tax. And also, if you sell a building because you're sure that there's no option to tax and you've checked that out with HMRC, and they've eventually come back to you and said that there's no option to tax, it might still be the case that if you sold a property on a VAT exempt basis, that if that property represents a capital item within the capital goods scheme, which means that you spent a large sum on it and recovered a lot of VAT on improving that property, then if you sell that within the 10-year capital goods scheme adjustment period, you might find yourself facing a large capital goods scheme clawback of the VAT that you'd legitimately recovered because you're making an exempt disposal. So in that case, what you'd want to do is to opt to tax and charge VAT on the disposal. And also property disposals quite often can qualify as a transfer of a going concern and be VAT-free. So there's lots of different scenarios here. What I can say in the case of Balhousie Holdings, I hope I pronounced that correctly, which is a care home business centred in the northeast of Scotland, running a group of I think it was about 25 care homes, that in their particular case that's been going through the courts and has finally had a Supreme Court decision, that the actual VAT liability of the sale of the property was not in dispute, it was VAT exempt. But the point here was that they were doing a transaction to sell off property to a REIT, a real estate investment trust, as a sale and lease back to get funding into the business. So a very standard sort of transaction, sell the property, take a lease back. And then the question is, well, in VAT terms, is that two separate transactions or should it be viewed as a whole? And the reason why it's important here for Balhousie with their care home business is that they're a VAT exempt business, so any VAT is a cost. And what they did originally when they developed these care homes was that they got them zero rated because they were able to say, we're going to occupy these care homes for a qualifying purpose, i.e. a residential purpose, and we can issue a certificate to the developer or construction business, ticking the box saying that we're entitled to zero rating because it's a relevant residential property. There are other categories of property where this applies, like development of children's homes, student accommodation. I've never advised on this, but monasteries and nunneries are also in the list there. And also there can be charitable buildings as well. So if a building is a charity warrants that's going to make a non-business use of a building, it can get it zero rated. But in this particular case, the point, the really key point is that there's provision within Schedule 10 of the VAT Act that if the customer occupier has issued the certificate to get the zero rating, warranting that they're going to make a qualifying use of that property, but they then change that use within a 10-year period, then there's a clawback provision which bites and says that for the remaining part of the 10 years, on a prorated basis, there's a deemed VAT charge that kicks in based on that change into a non-qualifying use. And Balhousie quite reasonably said, well, hang on a sec, this is a funding arrangement. We're making a sale and a lease back kind of happening at the same time. Our occupation, our use of the building or buildings is not changing at all. So, you know, yes, there is this anti-avoidance measure that says there's a clawback with a change of use, but it's not like we're changing it to try and use it as offices or develop it into something else. We're continuing that use. So it brings out a couple of points that quite often, in my experience, come into property transactions about what is the intended use of a property and so on. And anyway, it went to the tribunal. This was described by the business as a potentially business-ending VAT liability, but it's been through the courts for 8 years, so there must have been 8 painful years, one imagines. And in this particular case, it went through the initial tribunal, said that the balhousie's arguments were stronger than HMRC's. HMRC had said, well, actually the law says that if you dispose of your property, your entire interest in the property, then that's what triggers the clawback. And so that's what's happened. There's a transaction of disposing of your entire interest, and then there's accepting a lease back, and those are 2 separate transactions. And then the tribunal went back into Hansard about what Parliament intended at the time that this measure was put in, and it said, well, actually, the purpose was clearly to prevent some kind of abuse and avoidance, and it wasn't there to catch things like a funding arrangement, such as a sale and lease back, which must be seen as a single indivisible whole. And the company, therefore, had not disposed of its entire interest, and the tribunal backed the company. HMRC appealed to the upper tribunal, and they said that the disposal of the entire interest, you must look at the transactions on a transaction by transaction basis. You can't look at what the starting point is and what the end point is. You have to take into account what's happened in the meantime. And that actually, as a matter of fact, the sale of land is a transfer of that party's entire interest in the land, irrespective of whether a separate interest in that land is obtained as a result of the overall commercial transaction. So HMRC sided with, the tribunal sided with HMRC and allowed their appeal. The company then appealed to the Court of Session, it being a Scottish case, and they went through all this ground again, and the judge looked at the fundamental principles of VAT and saying, yes, VAT is transactional in nature, but you must be objective about construing the transactions at each stage. Fiscal neutrality says that all economic activities have to be taxed in the same way, and so on. And cutting a very long story short, the judge said that the sale and leaseback had to be treated as 2 entirely separate transactions. It wasn't possible to regard them as a single whole. They were distinct. And so that's the transactional structure of VAT. There's a sale and then there's a leaseback. So the upper tribunal, the Court of decision was upheld, the Court of Session upheld the upper tribunal's decision. So then the taxpayer, on their last roll of the dice, went to the Supreme Court. That went before the court in January this year. And the judges found unanimously for the company in this case, but for slightly different reasons. But they said that the purpose of the legislation was clearly to deny 0 rating to someone who wasn't going to ensure qualifying use of the property. And so in that context, the disposal of the original interest in the property could take the form of several successive transactions. And it was only the last transaction in that chain where the person who had originally attained the 0 rating no longer had any skin in the game, as it were, that the clawback would be triggered. They looked, you know, in a great deal of detail at all of the different arguments. But they said that the sale and leaseback was simultaneous. There was never a moment when the company didn't have an interest in the property. And I find that quite interesting, that you're saying that there's a sale of the property and a lease back, but the Supreme Court is saying, well, the company still had an interest in the property. There's no kind of nanosecond in the middle where the company has no interest and is seen to have disposed of its entire interest in the property. And so they said that the two transactions should be regarded as a single composite whole, with the result that the company had not disposed of its entire interest. And so that, you know, as I said, to me, that's kind of quite noteworthy when looking at transactions, because I've seen people pay clawbacks before. And I think the situation is, if there is a care home business or a charity that's paid a clawback assessment within the last 4 years, you'd want to be going back and looking to see whether that could be revisited and some kind of refund claim could be made. So I'm moving on now to look at some recent or current developments with HMRC. And here, what I've done is pulled out some areas that I see crop up from time to time. Riots of Light maybe is one that's less frequent, but when it does crop up, there's normally a large sum involved, and it kind of concentrates the mind to get the VAT treatment right. Dilapidations is something that crops up much more frequently, and I think those of you who have been involved in any transactions recently involving dilapidations payments will probably be aware of some of the grief that HMRC has caused by one bit of HMRC not consulting with another and going off and creating a big bit of uncertainty. So this blew up in around September 2020, and the position is still not resolved. Excuse me. Since, you know, I've been doing VAT for 30 years, and in all that time, the position on dilapidations has not changed, and it's been very clear. And in fact, it's reflected in HMRC's published guidance. Notice 742 says a dilapidation payment is, whether that's said, actually, they say here the terms of the lease may provide for a landlord to recover monies from tenants at the termination of the lease or during the lease. I think in my experience, it tends to be not necessarily spelled out in the lease, but it's something that happens due to perceived breaches of obligations within a lease. And HMRC say in their published guidance, which is still there as we speak, a dilapidation payment represents a claim for damages by the landlord. The payment is not consideration for a supply for VAT purposes and is outside the scope of VAT. So we've always I've grown up with knowing that dilapidations is outside the scope of VAT. And what happened in September 2020 was HMRC published their Revenue and Customs Brief 12 of 20, which was basically looking at, not at property directly at all, but was in a kind of unintended consequences way. It was looking at early termination payments. And this is where HMRC were very focused on trying to get more money from telecoms companies for, you know, teenagers and their ringtones and so on, and then inadvertently set the cat amongst the pigeons in terms of the VAT and property transactions. And so what HMRC were looking at, where there were some European court judgments, Vodafone Portugal was one of them, which was saying that if there's an early termination of a contract and there's a payment of what was termed compensation, whereas it's always generally been accepted until now that a compensation payment is outside the scope of VAT. But here, because these early termination payments were explicitly envisaged within the phone contracts, in fact, their further payment or consideration for that supply of telecom services, and where those services are taxable, then the early termination payment is taxable. And HMRC sent out their business brief that said, aha, early termination payments, all sorts of other payments, compensation payments are now follow the liability of the main supplier and are taxable. And then people in the property world pushed back and said, well, what about dilapidations then? And HMRC said, okay, we'll need to think about that. We don't know. And it was all a bit embarrassing. And it was very clear that HMRC hadn't considered the full implications of this new guidance. And so then they responded in October 20, saying they were reviewing the matter. They told their officers not to take any proactive action to go and raise assessments in terms of dilapidations and so on. And then their position has been based on, informed really by rumour ever since, because HMRC said they'd be issuing new guidance shortly. Then it's next month, then it's next month, and there's been all sorts of rumours coming out of HMRC and via various property liaison committees who meet with HMRC. But as we speak, I double-checked yesterday with one of the members of one of these property liaison committees, and he said, no, there's still nothing from HMRC, nothing concrete. So we're up in the air, rather, about whether dilapidations are actually taxable for VAT or whether the traditional outside the scope treatment should still apply. And it was interesting that normally when HMRC do change their policy on something, they normally announce that the policy will take effect from a current or future date. They don't normally say that it would be retrospective, or sometimes they do. They say that the taxpayer has the option of making it retrospective if it would suit them. In this particular case, they said, well, this is the policy and it's always been the policy that these things are taxable, and therefore kind of threatening or suggesting that, assessments and retrospective liabilities could come out. But then equally, HMRC are not able to confirm their position insofar as it relates to dilapidation. And so certainly by March this year, two proposed effective dates for HMRC to introduce this change, because then they talked about introducing the change and making dilapidations taxable, but from a current date or future date. But a couple of these rumoured proposed dates had come and gone, with still no sort of white smoke emanating from HMRC's policy building, as it were. And so obviously it's created a lot of uncertainty as to what the correct treatment should be. What HMRC did do, though, is that they snuck out some kind of pointer, but without actually highlighting it to anyone. So just to try and explain, they'd issued this brief in September that sort of created all this uncertainty. Then there were various rumours, but no official announcements and sort of unofficial announcements, if you like, about clarifying their policy on dilapidations. And then what they did do in very late 2021, and it was overlooked by a number of people, including me initially, till it was highlighted to me, was that if you go to look for this business brief 12 of 20, there's a kind of a landing page on the HMRC website that gives you a link through to the business brief. And what they did was that they inserted some additional wording at the bottom of that landing page. So they didn't change the brief, but they, without highlighting to anyone, they inserted some extra wording that said that basically it's all a bit uncertain, and until the new guidance is going to be issued, businesses can either continue to treat such payments as further consideration for the contracted supply, or go back to treating them as outside the scope of VAT, as has always been the case, if that is how they treated them before the business brief was issued. But as I said, that was very sneaky, I think, in my view. And so The latest strong rumour is that it seems increasingly likely that HMRC will reverse their position and accept that dilapidations were in fact outside the scope, which of course is still in line with their published guidance. That hasn't changed, Notice 742. So if you want to go and check the position, you look it up, you've got the guidance. It's a very unsatisfactory situation. And what happens if you have transactions in the meantime? Well, I've seen cases where things might have been dilapidations but become something else that's definitely a taxable supply, so that VAT is charged on where there's an opted to tax property, the landlord charges VAT. That I've heard of a situation where there was provision made for VAT to be added, and an amount equivalent to the VAT was paid into escrow to be held by the solicitor pending HMRC publishing their guidance. But we're already half a year on from when they said they would clarify matters. But certainly what people should be doing at the moment with dilapidations is that is checking the latest position with HMRC, and certainly at the very least making provision in a contract to add VAT if VAT is applicable. Of course, you might have the situation of where that's fine, you could treat it as outside the scope with that provision to add VAT if HMRC change their mind again and issue guidance that says it's VATable. But what is the case where you don't charge or make provision for VAT, and then the tenant goes off and you've got no chance of getting VAT further down the track? It's not a very good situation. Something similar has happened in relation to overage. So here we're looking at the situation where the buyer has to make an additional payment or payments at a later date. Typically, if the land is developed or the buyer successfully obtains planning consent and the value of the land is increased. So the conventional view is that overage is further consideration for the original sale of the land. So the sale of the land has a particular VAT treatment, maybe exempt or subject to the option to tax and is standard rated, and then the overage payment happens later. It has a later tax point, but the conventional view is that you take the VAT treatment of the overage payment ties into the original sale of the land, and you apply the same VAT treatment. And you'd look really for reasons why that wouldn't be the case. HMR's view says very little actually about overage, but seems to suggest that conventional view is what applies. There's been some correspondence has been reported where they reflect that view. Now, what seems to be the case is that it seems that HMRC are saying that they're not sure that overage is further consideration for the original sale of the land. It might be a payment for something else. And if it's some payment for something else and not the land, then it's necessarily standard rated. So HMRC are reported to be considering the matter, or were reported to be considering it in early 2021 with a view to issuing new guidance, but we haven't seen anything as yet. So again, that's one to watch this space. Call options, where a potential seller of the land grants an option to a potential buyer the right to acquire the property later on specified terms or within a specified time. That might be for at a premium up front with a smaller purchase price, or the option being granted for a smaller amount with a bigger purchase price later on. So the established position here is that granting a call option, that sort of right, is exempt because you're granting an interest in land. So it's exempt but subject as ever to the option to tax. And but anyway, HMRC formed a view in a year or two ago that a call option was not in any circumstances exempt and was necessarily always standard rated. So you could have land that is not subject to the option to tax, and it's granting the call option is standard rated. What does HMRC's guidance say, though? It says that it's exempt but subject to the option to tax. That's what Notice 742 still says. The liability of your supply will be whatever the liability of the land or building would be if supplied at that time. And HMRC's internal manual that's open to the public, as it were, reflects the same view. If the purchase itself would be taxable at the time the option is granted, the grant of the option is taxable. If it's exempt at the time, then the granting of the call option is exempt. So what is HMRC's view in practice? They seem to be wanting to take the view or trying to construct a view that actually the UK's position on things like call options, preemptive options and so on is not actually a supply of land or an interest in land in the same way as the VAT directive suggests, and therefore they should always be subject to VAT. And I'll come on in a minute and go briefly through the Land Links case where HMRC tried to run this argument but lost it comprehensively. It's rather demolished by the tribunal. So I will come back to that one. Riots of Light is something similar. Again, doesn't come up very often in my experience, but when it does, it's quite often quite significant sums involved. Again, HMRC's long-held and widely understood view seems about to change. New guidance has been promised, but it still hasn't been issued. So usually this sort of issue arises when someone's right to light that they've enjoyed for many years is impeded in some way. So next door, there's a new development goes up, infringes on someone's rights to light, and the developer makes a payment to that building owner. So query, is that compensation, going back to the dilapidations point? Is it outside the scope because it's a compensation? No, I think essentially these payments have generally been regarded as related to land, and therefore, broadly speaking, exempt but subject to the option to tax. And so where you've got a right to light as an easement, then HMRC's guidance says the grant of a right to light is exempt. But then they do appear to be uncomfortable with this, and it's been mentioned that this is part of some rewrite of their guidance, which we await with interest. But interestingly, it talks here about the grant of a right to light. But here, are we talking about the grant of a right to light, or someone who is being compensated because they are conceding that right or surrendering that right to light? So, you know, HMRC's view is unclear. The guidance is unclear on this. If there is an option to tax, you'd think that VAT should be chargeable, and if that VAT is chargeable and is recoverable by the other party, then it all washes through and there's no VAT loss. But there is an interesting side question. I suppose if HMRC are right and they say the surrender of a right to light is not directly a land supply and therefore is standard rated, full stop, then any interaction with the option to tax is immaterial. It has no bearing. But then there's been a separate side debate about if there is an option to tax. Well, whose option to tax? Are we talking about the option to tax of the developer next door? You know, if I receive money, do I need to opt to tax the building of the developer next door, my neighbour's building, or is it because I've got an option to tax on my own building? And that's unclear, and HMRC's view has flip-flopped a little bit on this. You know, I've heard of cases where an amount has been received and the recipient has opted to tax their building and the neighbour's building, the developer's building, just to be on the safe side and ensure that they're receiving a VATable chunk of income and not a big exempt chunk of income that might cause partial exemption issues. So it's rather unsatisfactory at the moment, but hopefully HMRC will clear that up. On this next slide, it's going back to, I suppose, trying to understand HMRC's thinking a bit more about some of these types of transactions. And land links estates is a case last year, the back end of last year, that they lost pretty comprehensively. And this was, and this I think shows some of the difficulties with HMRC guidance. One is that it doesn't really necessarily at the moment reflect their view on every matter, their real view, if you like. And sometimes you have to look really carefully and think, well, is the transaction squarely within the HMRC guidance, or is it something that's subtly different? And in land links estates, the background was that the company paid £1 to acquire a call option on a potential development site. That allowed the company to exercise an option to buy the site within a certain time scale in the event that there was planning permission was obtained for redevelopment. Land links duly obtained that planning permission, but rather than exercise the call option and buy the site, it accepted a payment of 1.4 million to release the site owner from its obligations. And that left the site owner free to sell the land or sell the development site to someone else with the benefit of the planning. Neither party here adopted tax, and land links treated the transaction as an exempt surrender of its interest in the land, having been granted that call option. But HMRC said it was standard rated, and they said you've got to account for VAT on that 1.4 million, and they raised an assessment. Now, we know that HMRC's assessment didn't accord with HMRC's own published guidance. But anyway, HMRC pressed ahead, and they said, well, actually, they said initially that their guidance was quite specific about saying only the grant of a call option was exempt, and that would be by the landowner granting the call option. That's exempt if there's no options tax. But the surrender by the other party of that call option was not a land supply, and therefore was taxable. By the time of the hearing, HMRC had modified their view again and said that even the grant of a call option was taxable, full stop, even though their guidance doesn't say this. And then said the call option was an interest in land. But then they said that you have to look very carefully, and then HMRC changed their argument and said actually the exemption from the VAT directive exempts a supply of goods and not a supply of services, and a call option is not a supply of goods, a supply of land, it's a supply of services. Anyway, the tribunal cut through all of this and said the supply is correctly exempt as the parties have treated it. And they said that the directive must mean that supplies that comprise the transferor's entire interest in the land and buildings, but also the transfer of a lesser or derivative interest in that land or building must be treated the same. And surely the purpose is to exempt transactions in land unless there's a reason to, or a movable property, unless there's a reason to tax it by it falling within certain exceptions. And that's the way everything had been since VAT had come in. And so they said, well, it would be a bit bizarre as well. The tribunal said that if Landlinks had bought the land, it would have been VAT exempt. But if it had bought the land, including paying for a call option, then it wouldn't have been entirely exempt. There would have been a different VAT treatment, and that's just bizarre. And you know, it's just an odd result. So HMRC have gone away, and we're, as I said earlier, we're expecting some new guidance around this type of transaction, but nothing has appeared as yet. And so, you know, what do you do in the meantime? You've got HMRC been arguing one thing in the courts, and their guidance says something else. You know, sometimes it's hoped that HMRC, when they lose a case, actually appeal it, because at least it might provide some certainty, but they've decided not to. And it's been reported that there's been some correspondence where HMRC say they consider call options to be exempt, but that doesn't seem to follow what their actual position is, but maybe they just don't know themselves and they're trying to work it out at the moment. So, you know, what do you do in the meantime? Well, I think it's still appropriate to treat the grant of a call option as exempt. You'd certainly want to make provision in a contract that VAT could be added. You might consider opting to tax to make sure, but then you might be opting to tax unnecessarily, just to get the VAT straight on the call option. So again, it's all rather unsatisfactory. If you are assigning or surrendering a call option, you know, HMRC have been keener to say that that is a taxable transaction, full stop. And they might have a better argument, because that certainly is arguably supported by their published guidance. But maybe put an option to tax in place kind of removes any doubt. Very, very briefly, the Colchester Institute Corporation case. I just wanted to flag that. It's another significant case in the VAT world. And it's really because of a knock-on effect on zero rating of property developments. The case was actually looking at whether Colchester Institute was making business supplies of education that are VAT exempt, or whether it was making non-business activities of education. And the tribunal the upper tribunal has rather changed the prevailing VAT treatment here, and it's saw grants from like the Education Funding Agency as creating a business activity, albeit an exempt business activity. But the knock-on effect is that some educational institutions, charities, etc., can get zero rating for buildings where they're used for a non-business purpose. In this particular case, the Colchester Institute then has although it's about education funding, has a knock-on effect, because it now creates doubt that where an institution is getting essentially grant funding, has it now got a business activity, whereas previously we would have thought it had a non-business activity and could have got the zero rating for its building. Moving on to my final slide here, and it's a bit of a roundup of some transactions issues, which I'll go through. I'm conscious of the time and want to leave some Q&A, so I'll keep it as brief as I can. The first point was to flag up about notification of the option to tax. And one thing to be aware of is that normally there's a 30-day period in which to notify HMRC of a decision to make an option to tax. So you normally would do it with a VAT 1614 form and send that off to HMRC within 30 days of having made the decision. Last year, because of COVID-19, there was a measure that extended that 30-day limit to 90 days. That was extended up to 31st of March. That's been extended again to 30th of June this year. So that recognises that sometimes people have difficulty in getting board minutes finalised and signed and decisions agreed and things like that. So that is an easement. It's worth remembering that notifications can be emailed to HMRC. HMRC are currently very slow to respond to option to tax notifications. So if you've got your form correctly filled out and meet all the conditions for an automatic permission, and you've got your email confirming that you've sent it off to HMRC's option to tax unit, at least in a transaction, you've got some evidence you can provide to the other side as proof of your option to tax. On the option to tax, something I saw on a case very recently was around disapplication of the option to tax. It served as a useful reminder that there are situations where, even though there's an option to tax on a building, it can be disapplied. So, for example, if there's a commercial building and it's going to be bought by a charity that's going to use it for a non-business purpose. So that wouldn't be a charity that's going to use it as a warehouse for its charity shops or use it as offices. But if it was going to use a building in some way for create a venue or drop-in centre or something like that for non-business purposes, then the option to tax by the seller is disapplied. And that is great for the charity because it means it doesn't have to pay VAT on the building. Less great sometimes if the building owner who's selling it might face a clawback under the VAT capital goods scheme, as we mentioned earlier. And so it's always worth looking at these transactions to understand who the buyer is and what the potential use is before getting too far down the track. The particular case that I saw recently was where an option to tax had been made on a commercial building that was being bought by a developer with the intention of converting it into residential units that were going to be sold off. And in that particular case, there were a couple of things that came into play, but we were able to say to the seller, actually, the option to tax can be disapplied, which is there's provision for that to happen by the buyer or potential buyer filling out a form 1614E, I think it is, and providing that to the seller to say that there's no option to tax on the property because we're going to do a residential conversion. Then it's also, but that has to be done before the price is fixed. There's also the case that where a seller makes an option to tax, they can rescind that within a short period of having made the option to tax if they've not made any supply of the property. So it can be a way of reducing the VAT cash flow cost and maybe the stamp duty cost because that's calculated on the VAT inclusive value. Romping through this quite quickly then, beneficial ownership is an issue that's come up a couple of times. A reminder that it's a point that does get overlooked, I think. But this is where you have an ultimate beneficial owner of property and they might appoint a nominee to act as legal owner of the property, possibly in some cases to preserve anonymity regarding the true ownership for whatever reason. The reminder is that in para 40 Schedule 10 of the VAT Act, there's provision within there that says that it's the beneficial owner who is regarded for VAT purposes as the person who's making and receiving the supplies of the property, not the legal owner. And also, very specifically, it says that it's the beneficial owner who's the person who has the right to deduct input VAT in relation to the property, not the legal owner. So where there is that beneficial owner nominee relationship and there's an option to tax involved and things like that, you need to look at it very carefully and make sure that if you are registering the legal owner, the nominee for VAT and opting to tax, that you'd mirror that with the beneficial owner and vice versa. And HMRC recognise that there can be a kind of fictional supply chain between the two to move the VAT on expenditure, for example, through to the beneficial owner. HMRC's guidance on this is thin, to be fair, but it is a point that if it goes wrong can be quite costly. I won't actually. I think we're running out of time a bit, so I won't go into any detail on these two cricket club cases. But again, it's a reminder that there have been quite a few local community sports clubs, cricket clubs, rugby clubs, and so on, who have been looking to get 0 rating for the development of their new clubhouse venue, trying to, in some cases, some clubs have been successful arguing that they're like a village hall and they can get 0 rating because of this. One of these cases was looking at whether a community amateur sports club was a charity or not. The courts have said, no, it's not a charity and you can't get 0 rating on that basis. One of the cases here, the ancient case, was interesting because the tribunal held that although the club had obtained 0 rating by issuing a certificate, and that was incorrect, they'd acted in good faith and they had reasonable excuse against the penalty that HMRC tried to impose on them for issuing a false certificate. And they said, well, HMRC had given some guidance, it was misleading, they'd acted in good faith. Actually, they shouldn't have ticked the certificate saying that they were a charity because they weren't, but actually maybe they thought they were because they thought a cask was a charity at the time. So getting these kind of details right is very important. And there was a case I saw just last week on a reminder on a similar point, which was a fish and chip shop that got done for suppressing its takings. And HMRC said, the tribunal said, yeah, absolutely, the assessment is pretty much, bang on and so on. But yes, we agree with you, Mr. Fish and Chip Shop, that HMRC issued their assessment too late. And it's a reminder that HMRC should issue an assessment within a year of having sufficient evidence of facts in order to issue that assessment. And if they don't, it's out of time. And then an assessment defaults to, HMRC can only go back 2 years at that stage. And so a lot of the early part of the assessment fell out of time. But interestingly, the tribunal said that HMRC had issued an assessment because of this rather blatant suppression of takings, and they'd issued like a large penalty on the taxpayer as well, but the penalty still stood because the penalty is calculated on the VAT that was due. And the tribunal said, well, the VAT is still due, it's just not collectible because it couldn't be assessed in time, but it was still VAT that was, it was identified as being due. And so, although the assessment for the VAT was out of time, the penalty was still due, which was a rather unfortunate result. And the final point, we are running out of time, I think, aren't we? Waiting for James to nod at me here on the screen. But it was a reminder, something I've seen quite often, and also on a case here in relation to a DIY claim, do-it-yourself builder claim, is having the right planning consent. And in this case, and it's something I've seen in practice a number of times over the years, in order to make a claim to get VAT back when you build your own house, you've got to have the right planning consent. And if you start off with planning consent to extend or convert an existing building, but then demolish it and build a new building, yes, you built a new building, but if your planning consent isn't to build a new building, and it's done retrospectively, if you've not got it all in place at the time of your claim, then you can't get your VAT back. And so on that note, I will hand you back to James.
Thanks, James. That was very informative. The trials and tribulations of dealing with HMRC on a daily basis. We've got 5 minutes for questions, and there's a couple of questions already come in. If I could turn to those.
Yeah.
Is it possible, could you just touch on how options to tax interact with TOGC transactions?
Yes. Yeah, I mentioned options to tax briefly, didn't I, earlier, about the notification. And I think one of the practical difficulties is with a transaction is getting being able to evidence the other party that you've made the option to tax and so on, because in the old days you'd make your notification, you'd get something back from HMRC and you could show the other party. Now you're having to put together slightly alternative evidence. But the key point is that there is a transfer of a business and you meet all of the normal conditions for a TOGC, and they all have to be met so that there is a business there. It's a going concern, it's capable of being transferred, and et cetera, et cetera. Now, where the assets include property that is subject to VAT, either because it's opted to tax or it's a new commercial building, then for that asset to be part of the VAT-free TOGC, then the buyer, the transferee, has to opt to tax and make a valid option to tax, and have notified it to HMRC prior to the relevant date. And the relevant date is the tax point, the first tax point. And that's normally taken to be completion. So the key point there is that the option to tax has to be made by the buyer, and they have to have notified it to HMRC by completion. Now, a tax point could arise if there was a deposit paid, but if that deposit goes to a solicitor acting as stakeholder, then that wouldn't create a tax point. So in reality, in most cases, it's completion. And the buyer also has to warrant that their option to tax is not disapplied. And normally there's no standard form of words for that, but normally that can be woven into the agreement, the contract, to give. And there are cases where the option to tax might be disapplied. So if there was a transaction between connected parties and the buyer was going to have an exempt use of the property, their option to tax might be disapplied. And therefore there's a very tricky point there about whether VAT is chargeable or not on the transfer of the property. I suppose just the other bits on TOGC, just to throw them in there, that I've seen recently that do crop up a lot is one of the key conditions for standard conditions for any TOGC is that where the seller, the transferor, is a taxable person, which means that they're registered or liable to be registered for VAT, the buyer or transferee must also be a taxable person, which means that at the time of the transfer, if the seller is registered for VAT, the buyer must be registered for that or liable to be registered for that. So where you're talking about a property being transferred and it's opted to tax, and the annual value of rent is above the VAT registration threshold of 85,000, then even though the buyer at that stage hasn't got their VAT registration in place and they're still waiting to hear back from HMRC, it'll still be a TOGC because they're a compulsory VAT registration. But if, as we sometimes see, the annual value of rent going in is below the VAT registration threshold of 85,000, and that's the only taxable income in the hands of the buyer, then actually for it to be a TOGC, you have to wait until the buyer has actually got hold of their VAT number from HMRC, which what we're finding at the moment is that there can be delays. It can either go through very quickly or it goes through very slowly. There's no halfway house at the moment. So that's what we see quite often on TOGCs.
Thank you. I'm conscious of time and that we are fast running out of time. We've got a couple more questions, but I think we can answer those offline and get back to the individuals concerned on those. Thank you for your webinar today and your presentation, James, and thank you to all the attendees for making time to join us for this. A reminder that the webinar has been recorded, will be available on our website shortly at brownbutler.com. Thanks again for your time today and hopefully see you soon. Goodbye.